I know you have some picks in healthcare. Surprisingly, Pfizer not making your cut though, Jay. So walk us through your base case. You've got UnitedHealth, Merck, J&J, and Amgen, but not Pfizer.
Well, I definitely don't have Pfizer. Pfizer's been a dog in the sector, and I focused on those 4 stocks. Why? Because they're in the Dow Jones Industrial Average. If you're looking for reasons why the Dow can rally, I give you healthcare. The healthcare sector continues to make higher lows as it goes along. All right, so what do we see here? We see nice continued higher lows. Every time it sells off, it continues to get a little higher, and it's consolidating in here.
Jay, I want to stop you for a second. Here's a 10-year chart, and I'm going to put some candlesticks back on. This is like I would call this a rare diamond formation. This is just consolidation in terms of a long-term secular trend, it looks like.
Well, the diamond formation could be a negative. This is a debate in the technical analysis community because sometimes this is a key reversal where you see it come down. However, yes, I do see the diamond, but the way the underlying stocks, the stocks within the index, the UNHs of the world, which is the biggest component of the Dow, because the Dow is price weighted.
Look at UnitedHealth. Very similar chart to XLV. This is 10 years, but I'm going to dial this down to a year to date, and we can switch that as well.
Yeah, UnitedHealthcare has been consolidating. It tested the 450 area here twice. And if you go back further in time, it's tested it several times. So we have a nice double bottom. It rallied above it. It's now above its 200-day moving average. And it can still run another 50 points and still be in this consolidation zone that we've seen. 50 points in UNH is another 300 Dow points. I think that's what we're going to see from it over the near term. And if you're a little skittish on the overall market, healthcare is a safety sector. So I think it's going to see some action.
2 more. We got Merck and Amgen. I don't know if we have time for both, but start with Merck.
Let's focus on Merck because Merck is playing out seasonally just like it had last year. We had some consolidating periods where we've seen drop-offs. And what has it done? It's rallied year-end. The stock is flat year-to-date. Over the last 12 months, it's up about 25%. But year-to-date, it's flat. If people are looking for performance, if they're looking for something strong within the sector, it's not only in the Dow, it's a major impact on the XLV, and the stock should rally into year-end based on what we've seen before and the fact that it's still making higher lows. I'm not very good at drawing with my finger, obviously.
That's fine.
But it looks like in this consolidation period above 105, I still like Merck, and I think it's still bullish.
All right, Rochelle, any more?
Well, I was going to say, for people who are perhaps not familiar with some of the terms like diamond formation, what is the best way for them to sort of view some of the changes that they're seeing here?
Love it. Trader education.
Trader education, risk management, obviously rule number 1, number 2, number 3 when trading. When you get into the trade, you want to have levels. If this doesn't work out, like I just said in Merck, 105, something has changed to me, and I will take that loss. I will limit that loss. The formations are fun to follow, but I look for continuation patterns, and I'm seeing setups that can show continuation to the upside. So the risk-reward setup to me in these stocks and in the sector is definitely bullish.
Jay, we got to go. Really appreciate you. Anybody who wants to learn about trading, also follow Jay Woods on Twitter, your handle.
At JWoods3.
There you go. Rochelle.